Hello students, this is C. Prabodh Naik here once again. In this lecture today, what we are going to do is, we are going to do the security evaluation part, which means that I will require you to have your CMS material, which I have given to you in PDF format, ready before you. You should have your calculator before you for calculation and a notebook to solve the problems, because we are today going to solve the questions from our material. And for that, as I said, you will require a notebook, pen, pencil, whatever is required, stationery material, calculator, very essential, and your CMS material downloaded so that you can understand what question we are doing and the adjustments of the questions can be understood. Okay, so this lecture will be of a longer duration as most of the students wanted it that way, and many of the students have given some good comments. I appreciate that, but still only a few students are writing the comments. The other students, I think, are feeling shy. I've said before also, do not feel shy to write whatever comments you want. Even if you feel that lecture is good, please don't feel shy to write that the lecture is good, so that I come to know that you have gone through the entire lecture and whether you have understood or not understood. Okay, as some students pointed out that they wanted a lecture of a longer duration, that is more than 1 hour. So this lecture, I suppose, will be more than 1 hour, and it will be covering a lot of questions, practical questions that we are going to solve from our book. So before you move further, ensure that you are having your CMS ka PDF file downloaded. Number one. Number two, calculator. Number three, your notebook and other stationery required for writing down, for solving the problems. Okay. So today we start with security valuation. For that, I will require you to open your CMS material to page number 66. Page number 66. Okay. Shall we start? So on page number 66, we are having valuation of shares, valuation of preference shares. Preference shares valuation. Now, first of all, when we are doing valuation, let me recall that we have done something called as intrinsic value in the very first lecture. If you have seen all my lectures, lecture number 1, I have introduced the concept of intrinsic value, where we have said that intrinsic value is nothing but the present value of all the future cash flows. Okay, so present value of all the future cash flows. So if I'm looking at it from the intrinsic value point of view, valuation of all the shares, I'll be looking at it from the intrinsic point of view, intrinsic value point of view. So in that case, I first start with redeemable preference shares, or valuation of preference shares, you can say. In valuation of preference shares, the first thing that we are going to do is preference shares which are redeemable. Now, in preference shares, we have two things that we are going to receive. If it is a redeemable preference share, I will be receiving dividend and I will be receiving the redemption amount at the time of redemption. So these are the two things that I'm going to receive. Okay. Now, as far as redeemable preference shares are concerned, the dividend is going to be fixed in rate. So it is a fixed rate of dividend. So the amount is going to be the same for all the years. And the present value of all those dividends is going to be the same amount every year. So it is going to be a case of annuity. Present value, how do we calculate? 1 divided by 1 plus k. So if you see here, present value of an equity share, of a preference share, is equal to this part is what? Present value of dividend. Okay. Plus at the time of redemption, we are going to receive the redemption value. RV is the redemption value. So redemption value, that also is going to be discounted. So the present value of the redemption value. So total of all the dividends that we are going to receive in the form of annuity, and the redemption value that we are going to receive at the end, towards the end, at the time of redemption, maturity of the preference shares, uska present value. Now of that present value, when we are calculating, we divide by 1 plus k. Okay, so that is redemption of preference shares. Now coming to irredeemable preference shares. Irredeemable preference shares, if you go to see, we have the formula as dividend upon KP. KP is cost of preference shares. Now actually we have done this in the inter CMA, that is FM financial management web that we are doing. KP is equal to dividend upon subscription value. The subscription value I can replace it by market price per share. So I've just cross multiplied this. That is why I said that cost of capital becomes an important topic for us. So I cross multiplied this P0 on the left hand side. So right hand side I have got dividend in the numerator and KP comes down in the denominator. Okay. So if it is a irredeemable preference share, then it is dividend divided by cost of preference share. Coming to equity shares, valuation of equity shares. Valuation of equity shares little bit difficult because there are different cases which can arise. Because in equity shares the dividend is not fixed. So I can have a case where there is no dividend at all. So zero dividend, zero growth rate in dividends. No dividend in the sense no growth rate in the dividends. So if there is no growth rate in the dividends, no dividend also I will come to. If there is no growth rate in the dividend, it is called as dividend price approach. So dividend price approach, the formula for calculating the value of equity share is P0 is equal to dividend divided by KE. KE is equal to your cost of capital, cost of equity. KE is cost of equity. Okay. Now, if there is a constant growth rate in dividend, it is P0 is equal to D1 upon KE minus G. Actually, this formula is coming from where? It is coming from the Gordon's formula. KE is equal to D1 upon P0 plus G. What we do, this G we take on the left hand side. So it becomes KE minus G is equal to D1 upon P0. Now I cross multiply this. This will come here, this will come here. So P0 is equal to D1 upon KE minus G. So you can see that we are making use of the formulas of cost of capital. And that cost of capital formula is coming up and giving us these values of preference shares and equity shares. Acha, if the growth rate in the dividend is variable, if it is a fixed growth rate in the dividend, then it will be this formula. This is for fixed growth rate. Acha, now suppose in the problem we are given the dividend at present. This is important. Dividend at present. Then to calculate D1, because D1 is the dividend at the end of the year. D1 is dividend at the end of the year. Pay a dividend equal to D0 into 1 plus G. So if I am told, for example, that the amount of dividend paid D0 is equal to say 10 and the growth rate is equal to 10%. Okay, then D1 will be equal to 10 plus 10%. That is equal to 11 rupees. Okay, 10 plus 10%, that is equal to 11 rupees. That is what I've got here. D1 is equal to D0 value plus the growth into 1 plus K. Okay, 1 plus G. So that same thing I have put it in the form of formula here. P0 is equal to D1 upon K minus G. Now here G is always a constant growth rate. Constant growth rate. But if the growth rate is not constant, if the growth rate changes, that in the first 2 years, see, company may show growth rate in the dividend of 3% for the first 2 years, then growth rate may be 5% for next 3 years. Thereafter it is 7% to the 10th year. So something like this is given to you. Then in that case the formula will not be the same. Then what you have to do is, in this case, first the amount, find the amount of dividend in each of the years, that is 3% for first 2 years, 5% in the years 3 to 5 and 7% for years 6 to 10. Then find out the present value of all these cash dividends, find out the value of the equity share by taking the total of all this. Now for this I have given you a small example here. Let us go through the example. Company is paying a dividend of 1.65 per share. Rate of dividend is expected to grow at 10% for 3 years and 5% thereafter infinitely. Okay, Find out the value of the share given that the required rate of return of the investor is 15%. So dividend is 1.5 in the first year. As of now, company is now paying a dividend of 1.5. It is understood. Paying a dividend of 1.5, it means now, present. Rate of dividend is expected to grow at 10%. Growth rate is 10% for next 3 years. And after that, it is infinitely. That means it is going to be indefinitely. So what I do is year one means end of the first year. It will be 1.5 plus 10%. 1.5 plus 10%. That is 1.65. Then 1.65 plus 10%. Plus 10% will give me 1.82. 1.82 plus 10% will be 2. Now this stops over here. Okay. And then since the dividend is going to fall to 5%, I'm going to sell the shares. So how did I get this 21 rupees? 21 rupees is calculated by taking P3. This is P3 na, at the end of third year. So P3 is equal to D4 upon KE minus G. Now D4 is equal to what? It is 2 plus 10, 2 plus 5%. Growth in the fourth year is going to be 5%. So 2 plus 5% divided by KE. KE is 15 minus 5%. So if you calculate this now, use a calculator. If you calculate this now, it will come to 2 plus 5% is 2.1 divided by 10%. That is 21 rupees. So 2.1 divided by 10% is 21 rupees. That is how I've got this. Okay. So have you understood how to calculate this 21? This 21 is calculated in this way. P3, because price at the end of third year, I'm going to sell the share. Why I'm going to sell the share? I'm going to sell the share because I was having actually an abnormal growth rate of 10%. 10% is my abnormal growth rate, very high growth rate. Now after 3 years, in the fourth year, it is going to be 5%. So I will sell off the share. Now I'm not interested because the growth rate is now only 5%. So now I will sell the share. And when I'm selling the share, I will be selling the share at the end of third year. So I want to know what is the market price P3. Market price at the end of third year. That is why P3. P3 is equal to D4 upon KE minus G. Okay. So P0 is equal to what? D1 upon KE minus G. So P3 is equal to D4 upon KE minus G. D4, how to get D4? D3. D3 is what? This is D3. 2 rupees. 2 rupees plus 5% will give me D4. And KE. KE is what? Cost of equity. Cost of equity is 15%. Your discounting factor minus 5%. So 2.1 divided by 10%, it is 21. Now I calculate discounting factor at 15%. How to calculate? 1 divided by 1 plus K. So 1 divided by 1.15. First figure will give me 4 figures, 0.8696, then 0.7561, then 0.6575, 0.6575. Multiply these two, I will get this. Take the total of this. It is 17.94. Intrinsic value. Present value of all the cash flows. Present value of all the cash flows. I have told you this, intrinsic value. Okay. Second example. A company has raised equity capital for a project. Okay. Company has raised equity capital for a project that may not start earning profits in the first 3 years, but thereafter it will pay a dividend of 2 rupees per share. So the example you can just go through. Valuation based on earnings I have given to you. Now what is important here is Walters model. Look at Walters model. Look at Walters model. Formula you have to study. P0 is equal to D. D means dividend. Dividend paid plus R upon K. R upon K. R is the rate of return on the investment. K is cost of equity into E. E means earnings minus D again dividend divided by K cost of capital. Okay, Walters model. So now this Walters model is actually coming from the dividend policy. So as of now, there is no need to go into the depth of this. Just learn the formula. It is D plus R by K into E minus D, the whole divided by K. So now we have price earning ratio, another method, price earning ratio. From here we are getting one more formula. P0 is equal to EPS into P ratio. Why? Because we know formula for a P ratio. P ratio is equal to what? Formula. It is price upon earnings. MPS upon EPS. Correct now? And MPS is nothing but P0 upon EPS. Now cross multiply EPS to P ratio. EPS to P ratio. Cross multiply. We'll get this answer. Any difficulty? So that is why I said that cost of capital, ratio analysis, these topics of inter financial management will become useful for you. Those who have not done financial management in inter, you have to go and check the books of inter CMA, financial management, topic cost of capital. And then this P ratio formula is coming from ratio analysis. Okay. Valuation of rights issue. In that, two formulas are important. Value of a right is equal to come right market price, MP is market price, minus offer price upon N0 plus N1. N0 is existing number of shares. N1 is number of new shares offered in the rights issue. Come right price minus offer price. Acha, next thing that is important for you, next formula that is important for you is this formula. Market price X rights, ER means X rights, is equal to market price, come the rights. Come rights means what you have calculated above, minus VR. VR means what? Value of a right. Okay. So these formulas are important for you. This is the new formula. Rights issued is a new formula. Achha, let us come to now question number 1. I suppose we are having your notebook, calculator, pen, pencil, whatever you require. Okay, because I'm going to start with the problems now. Pay attention. Everyone is ready? Shall we start? Okay. I'm reading out the first question, then we will do the solution of the first question. Everyone is ready? Okay. First question says, a firm has paid dividend at 2 rupees per share last year. At 2 rupees per share last year. Last year means for last year. So this is 2 rupees is D0. Estimated growth rate of the dividend from the company is 5%. Growth rate is 5%. So D1 will be 2 plus 5%. Okay. D1 will be 2 plus 5%. Is that clear? Okay. 2 plus 5% will be 2.10. Now, determine the estimated market price of the equity share if the estimated growth rate of dividend rises to 8%, case 1, falls to 3%, case 2. Also find out the present market price per share given that rate of return of equity investors is 15.5%. What is this? This is KE. 15.5% is KE. So three things are asked. What are the three things? Current market price with cost of equity 15.5. Okay. Then they have asked you what is the market price of the growth rate is 8%. Current market price with 5%. Then if the growth rate increases to 8%, then what? If the growth rate falls to 3%, then what? So there are three parts to the question. Understood? Let us see how to solve now. So now, growth rate is given to us as 5%. So I'll be writing that first. That growth rate is 5%. If the growth rate is 5%, then calculation of P0. P0 formula D1 upon K minus G. D1 is equal to 2 plus 5% divided by Ke minus G, that is 15.5 minus 5%. Okay, so that comes to 2 plus 5% will be 2.1 divided by 15.5 minus 5, that is 10.5%. 2.10 divided by 10.5%, we'll get the answer as 20 rupees. So I can say that if the growth rate is 5%, the current market price should be 20 rupees. Okay. Simple part. I told you there are three parts to this. So this is the first part. Then we have two cases. Case 1, if the growth rate is 8%. Case 2, if the growth rate is 3%. Okay. So let us see now case 1, that growth rate is 8%. If growth rate is 8%, formula remains the same. P0 is equal to D1 minus D1 upon KE minus G. That is equal to 2.16 divided by 7.5%. So we'll have this D1 upon KE minus G. 2.16. How did I get this 2.16? It is now 2 plus 8%. Growth rate is 8%. In the previous part, it was 2 plus 5% because growth rate was 5%. Now it is 2 plus 8% divided by 7.5%. How did I get 7.5%? It is 15.5 minus 8%. 15.5 minus 8% is equal to 7.5%. 2.16 divided by 7.5% comes to 28 rupees 28 paise, rupees 28.80. So if the growth rate is 8%, the current market price should be 28 rupees 80 paise. Clear? Case 2. Case 2 is if the growth rate is 3%. Formula is same, D1 upon KE minus G. Now D1 will be 2.06. How do I get this 2.06? It is 2 plus 3%. 2 plus 3%. How do I get 12.5%? It is 15.5 minus 3%. 15.5 minus 3%. So 2.06 divided by 12.5% will give me 16.48 as the answer. So this is how we solve the question. Any difficulty? Let us see now how to take the second question. Question number 2. A Limited has just paid dividend of rupees 13 per share as a part of its major reorganization of its operations. It has stated that it does not intend to pay any dividend for the next 2 years. Reorganization, if we are doing, then no dividend to be paid for next 2 years. In 3 years' time, it will start paying dividend. That means from third year onwards, it will start paying dividend of 10 rupees per share. And the directors have indicated that they expect to have a dividend growth at 12% per annum thereafter. This is if the reorganization is done. So in reorganization is done, first 2 years, no dividend. So D1 is 0, D2 is 0. D3 will be 10 rupees onwards. Okay. And the growth rate thereafter is 12%. This is clear? Okay. If the reorganization does not take place, that means there are two possibilities here. There are two cases here. Case 1, reorganization takes place. Case 2, reorganization does not take place. Then in that case, dividend will be paid in the next 2 years, and the expected dividend growth rate will remain at present level. Okay, present level of 6%. Firm's cost of capital 18%, that is KE, it will be 18% and will be unaffected by the reorganization. Calculate the value of the firm's shares in both the cases. So let us see now, in both the cases, if we are going to calculate, what will be the value. So, First, I'll say if reorganization is carried out. What did we say? If reorganization is carried out, first 2 years dividend is nil. So D1 and D2 will be nil. D3 will be 10. Growth rate is 12%. So D4 will be how much? If I want to calculate D4, it will be D3 10 plus 12%. That is 11.20. P3 is equal to D4 upon KE minus G. 11.2 upon 18 minus 12%. 11.2 divided by 6%. That comes to 186.67. What is this value? This is P3 value. I want P0 value. So P3 value, this I will discount it by 3 years. Discounted by 3 years. Okay, discounted by 3 years. At what percent? At 18% PE, cost of capital. Plus I'm going to receive dividend now. In third year I'm going to receive dividend. So of that also present value I need to calculate. So it is 186.67 into PVIF at 18% for 3 years. Discounting for 3 years because this is P3. This is P3. So I want to calculate P0. So discounted by 3 years plus dividend of 10 rupees discounted for 3 years. So in that case, what do I get? I'll get 186.67. How do I calculate this? 1 divided by 1.18. 1 divided by 1.18 equal to function 3 times. So I'll get 0.6086 multiply. I'll get 113.61 plus 6.09. That comes to 119.70. So that means if reorganization is done, this is going to be the market price of my equity share now. I have to compare this with the figure if reorganization is not done. Whichever gives me a better market price, that I will be selecting. Okay. So now let us see the next one. If reorganization is not carried out, P0 is equal to D1 upon K minus G. 13 plus 6%, that is growth rate, and 18 minus 6%. So 13.78 divided by 12%, that comes to 114.83. In the first case, we had 119 in the first case. Compare this now, 119.7 we had got. So this to be compared with this, these two figures to be compared. So in case 1, case A, I am getting a higher figure than case B. So what do I say? We can conclude that reorganization should be done because that will increase the wealth of the shareholders. So the final answer will be, from the above calculations, we can conclude that the company should carry out the reorganization as it will increase the wealth of the shareholders. Okay. So have you understood the first two questions now? Okay. Let us come to question 3. Question 3 says, ABC Limited provides the following information. Current dividend is 2.50. So what is 2.50? It is D0. D0. Discounting rate is 10.5%. What is 10.5%? That is KE. Growth rate is 2%, G. Calculate present value of stock of ABC Limited. Is its stock overvalued? If the stock price is 35 rupees, returns on equity is 9% and EPS is 2.25. Show the detailed calculation. Okay. So again, two parts are there. So first part is to calculate present value of company's shares. Present value of company's shares. Given that current dividend is 2.5, discounting rate is 10.5, growth rate is 2%. So what do? I first calculate D1 value. 2.5 plus 2%. Okay, 2.5 plus 2%. Question 3. D0 is 2.5, G is 2%, KE is 10.5%. D1 will be 2.5 plus 2%. So 2.55. P0 is equal to D1 upon KE minus G. So 2.55 divided by 10.5 minus 2%. 2.5 divided by 8.5%. That will come to 30 rupees per share. So present value of company's share is 30 rupees per share. Okay. Second part now. What is the second part saying? Second part is saying that stock price is given to you. Look at the question. Stock price is given to you 35 rupees. Returns on equity is given 9%. EPS is 2.25. Correct? Now returns on equity is nothing but cost of equity. So cost of equity means what? KE. That is given to us as 9%. Now P ratio is equal to 1 upon KE. That is as per the earnings price approach. Earnings price approach. Earnings price approach, KE is equal to EPS upon MPS. Okay. So KE is equal to 1 upon EPS upon MPS. And EPS upon MPS is equal to what? 1 upon P ratio. So KE is equal to 1 upon P ratio. So P ratio is equal to 1 upon KE. From there we are getting that. Okay, that is why cost of capital of inter CMA financial management topic is very important. That is why I told you revise and come. Okay, so P ratio is equal to 1 by 9%, that is equal to 11.11. But P ratio formula is MPS upon EPS. This is actually MPS upon EPS. MPS upon EPS. Okay, P ratio is MPS upon EPS. Cross multiply. P ratio and EPS will multiply. So MPS is equal to P ratio into EPS. P ratio is 11.11. EPS is given to me as 2.25. So MPS is equal to 25 rupees. So actual price is 35 rupees. MPS is 25 rupees. Actual price is 35. It should have been 25. Should have been 25. Actual कितना है? Actual is how much? Actual is 35. So actual is overvalued ना? Actual price is overvalued. MPS should be 25 rupees. Should be 25 rupees. But it is not. It is 35 rupees. So it is overvalued. It is overvalued. Okay. Any problem you can tell me via the comments. I've told you. Comment section is there. Please, please, please see that you write your comments. Followed, not followed, understood, not understood, what you have not understood, or alternatively, you can message me on my number, not in the group, in my number. You know my number. What is my number? 982 00 64530. Whatever is your difficulty, message me on this number, not in the group, please. And when you are messaging me, tell me your name and your difficulty, your query and your difficulty. Because I am not having only CMS students, I am having students from different parts of the country. So when they are writing, I should know which student is contacting me, what question you are asking me. Followed now? So that is why I am saying, write your name and then write the query. Let us come to question 5 now. Question 5. Not 4, 5. First 5, then 6, then 4. Why? Because 4 is little bit difficult, little bit lengthy. So we'll take that afterwards. Question 5. Company pays a dividend of 2 rupees per share. company pays a dividend of 2 rupees per share. Whenever this statement comes now, whenever this statement comes, it is actually 2 rupees, whatever this 2 rupees is given, this is D0. Growth rate of 7%. Risk-free rate is 9%. RF 9%. Market rate of return RM 13%. Company has a beta factor of 1.5 beta. Decision of the finance manager, beta is likely to increase to 1.75. Find out the present value and the likely value of the share after the decision. RM is given, RF is given, beta is given. We have to make use of CAPM formula. CAPM formula. It is again one of the formulas that we have got in cost of capital. As per CAPM formula, KE is equal to RF plus beta into RM minus RF. If you have left this topic for option, you have to study now. You have to study inter and final together. If in inter you have left this topic cost of capital for option, then you have to study inter and final together. Those who are coming from old syllabus to new syllabus, I don't think anybody is there from the old syllabus inter CA, CMA. Old syllabus FM was not there. Okay. Now, in this particular case, RF plus beta into RM minus RF. So KE first we have to find out. First we have to find out KE by making use of CAPM formula. Followed, not followed, read again. Inter CMA, financial management, topic cost of capital. Okay, let us see. First we have to find out cost of equity. Formula CAPM, RF plus beta into RM minus RF. What is RF? 9%. What is beta? 1.5. What is RM? 13. So 13 minus 9 is 4. 4 into 1.5 is 6. 9 plus 6. 9 plus 6 is 15%. KE is 15%. Now to find the value of equity by the growth formula, dividend growth formula given by Gordon. Gordon's dividend growth formula. What is the formula? D0 is equal to D1 upon KE minus G. What is D1? D1 is D0 plus growth rate, 2 plus 7% divided by 15 minus 7%. That is 2.14. 2 plus 7% is 2.14 divided by 15 minus 7%. That is 8%. So you get first answer as 26 rupees 75 paise. 26.75. 26.75. This is when beta is 1.5. Beta is 1.5. You have to write fast, to copy fast, or you have to rewind and see the lecture again. You have to write fast or rewind and see the lecture again. Done. Achha, now second part of the question is, if the beta instead of 1.5 it is 1.75, then what? Method is same. First we'll find out cost of equity by CAPM. So cost of equity by CAPM, if beta is 1.75, formula is same. RF plus beta into RM minus RF. 9 plus 1.75 into 13 minus 9. 13 minus 9. 13 minus 9 is 4. 4 into 1.75 is 7. So 9 plus 7, 16. So cost of equity is 16. Growth formula. P0 is equal to D1 upon KE minus G. 2 plus 7% upon 16 minus 7%. So 2.14 divided by 9%. That comes to 23 rupees 78 paise. 23 rupees 78 paise. Difficulty? No, na. You have to write a little bit faster. It is. You have to do a lot of things. You have to do a lot of things. Okay? Up till here it is clear. That is why I said calculator, notebook, pen, pencil, everything should be ready when you are sitting for the lecture. Question number 6 now. Equity shares of Times Limited are currently traded at 80 rupees per share. What is 80 rupees per share? It is CMP. Come rights. This is a rights problem. Come rights. Market price. Company announced a rights issue at 50 rupees per share. What is 50 rupees? Offer a price. 50 rupees offer a price. In the ratio of 1 is to 3. 1 is to 3 ratio means for every 1 share, we are giving 3 shares. Rights issue, for every 1 share, we are giving 3 shares. So if you are having 1 share with you now, you will get 3 additional shares. You are required to find out theoretical post-right price issue, theoretical value of rights, and the gain or loss to a shareholder who has 300 shares of the company. So total number of shares of the company are not given. Total number of shares of the company are not given. This is third part of the question. Shareholder who has 300 shares. Third part of the question. But for solving the first and second part, I require to know the number of shares. Number of shares is not given, but I am given the rights per share, market price per share, 80 rupees. So what I will do, I will calculate VR. In the rights issue, I made you for put in box bracket 2 formulas. I said 2 formulas are important. The first formula was VR is equal to come rights market price minus offer price divided by N0 plus N1. Go and check back page number, whatever it is. It is just over here only. Check. See, here it is come. Come right market price minus offer price upon N0 plus N1. You have to study this formula. You are going for exam, not me. Second formula was what? Market price, theoretical post rights value. Market price X rights. Post rights means X rights. Excluding the rights. Excluding the rights is equal to market price come rights, including the rights, minus VR. VR is what you have calculated here. Okay, what you have calculated here. VR. So I'm going to make use of this now. So question number 6, we are making use of this. Okay. So come rights market price 80 rupees. Offer price is 50 rupees. N0 plus N1. Since I'm not given how many total shares, I'll say let the share be 1 share. Present number of shares 1. How much additional shares? N1 is additional number of shares. Additional number of shares say 3 shares. So N0 is 1, N1 is 3. Theoretical value of a rights share. Come rights market price minus offer price upon N0 plus N1. Come rights market price is 80, offer price is 50, N0 plus N1, 1 plus 3. 30 divided by 4, 7.5. That is the value of a rights. Value for rights. Theoretical post rights value of share. MP market price X rights. Formula X rights is equal to come rights minus value of rights. That is 80 minus 7.5. That is 72.5. So first and second part over. Calculation of theoretical value of rights and theoretical post rights value. Now we have to see the gain or loss of a shareholder if he accepts the rights issue and he is having 300 shares with him. Has he made a profit or has he made a loss? You have to calculate that. Theoretical value of rights share, come rights market price minus offer price upon N0 plus N1. Come rights market price 80, offer price 50, 1 plus 3. So when you're solving the problem, if you find that the slide is going a little bit fast, what you can do is you can pause. You can pause the movie, you can pause the video, and then copy down everything from the slide first and then proceed. Okay. No issue, no problem. We have to get adjusted to technology. You have to adjust, I have to adjust. Finished? Okay. Now let us see the gain or rights of a shareholder holding 300 shares. Now I do not know whether it is gain or loss. So I write there gain or loss. We are finding out now. As of now, he is holding 300 shares. Current market price is given to us in the question as 80 rupees per share. So 300 into 80, it comes to 24,000. 300 into 80. One is to 3 is the rights issue. One share for every 3 shares held. One share for every 3 shares held. So 300 into 1 by 3. 1 is to 3, no? 1 is to 3. So 1 share for every 3 shares held. So 300 into 1 by 3. So that means additional 100 new rights shares. Offer price 50 rupees. So total amount comes to 29,000. So first he was having 300 shares. Now he is having 100 shares. So total 400 shares. 1 is to 3 is 1 share for every 3 shares held. Okay. What is the theoretical X rights price? Post rights 72.5. 400 into 72.5. This you have to multiply. These two you have to multiply. 400 into 72.5. Total value is 29,000. Here also it is 29,000. Here also it is 29,000. There is no profit, no loss. So we can conclude that there is no gain or loss to the shareholders. No gain or loss to the shareholders. Okay. Done. Now let us come to question number 4. 4 is a little bit different type of question. Capital structure of a company as on 31st March 2017 is as follows. Equity share capital is 80 lakhs, preference share capital is 40 lakhs, 12% debentures, reserves of 32 lakhs. Company earns a profit of 32 lakhs annually on an average before deduction of tax, which works out to 32 lakhs annually on an average. So this is, I think, repeated. Okay, before deduction of tax, this is to be cancelled off, which works out to 35%. So tax rate is 35% and interest on debentures. So it is EBIT. This 32 lakhs is EBIT. 32 lakhs on an average before deduction of tax, which is 35% and interest on debentures. Before interest, before tax. Normal return on equity shares of companies placed similarly is 9.6%. Normal returns on an average basis, all equity shareholders of similar companies are earning returns of 9.6%. Profit after tax covers fixed interest and fixed dividends at least 3 times. Capital gearing ratio is 0.75. Matlab, all the other companies, this is the the benchmark, you can say. This is a benchmark that they are earning 9.6% on their equity capital, but profit after tax NPAT covers fixed interest and dividends at least 3 times to their interest and dividend coverage ratio. What do you mean by this? What do you mean by this? Their interest and dividend coverage ratio is 3 times. their capital gearing ratio is 0.75. So ratios are important. If you have not done ratios, very difficult time. In final, I always tell my students, professional students, CA, CMA, CS, that what you have done in the previous class, you cannot forget it now. You cannot say, Array, it is asked in foundation, now it cannot be asked. It can be asked. Even logs will be asked here. You'll have to make use of log tables. You better get started with your revision of inter CMA. Whatever you have done in foundation will come, you have to remember it for inter. Whatever you have done at foundation and inter, you have to remember for the final. So it is not that inter portion once you do, you forget. Foundation once you do, you forget. So when you come to final, you are new students. You don't know anything. You are learning something altogether new. It is not that way. You have to carry forward all your knowledge. You are being a professional dear. So in a professional person, you cannot afford to forget what has happened in the past. You have to carry forward what has happened in the past. So now you have to know capital gearing ratio. Third, they have said yield on share is calculated at 50% of profits distributed, 5% of undistributed profits. Company has been regularly paying equity dividend at 8%. Equity dividend is 8%. Compute the value of equity share of the company. Little bit difficult, little bit different. And at the same time, you have to know that this is a slightly different type of problem. It is not the usual problem. Okay. So to find out the value of the equity share, what is the formula? That also I don't know. I'll have to study that also. So all these things are new for me now. Okay. So let us do everything systematically. Systematically, what I will do first, I will start with EBIT calculation. EBIT is given to me 32 lakhs. I'll find out how much is the profit available for equity shareholders, how much is the profit, how much of dividend is paid, and how much of undistributed profits are there. Okay, and how to solve the problem. So starting with first EBIT. EBIT is given to me as 32 lakhs. Interest, debt capital is given. Interest. So interest on debt capital. What is the debt capital here? What is the debt capital? You can see that we are having 12% debentures. 8% preferential capital is given, equity capital is given. After that is given 12% debentures. That is what debt capital. On 12% is what? That is your rate of interest. So less now. 12% of 64 lakhs. That comes to 7 lakh 68,000. So net profit before tax will be 24 lakh 32,000. EBIT minus the interest will give you net profit before tax. Rate of tax they have given 35%. So less tax at 35%, 8,51,200. So net profit after tax will be 15,80,800. From this net profit after tax, first I will calculate dividend on preference shares. Dividend on preference share is already given to me 8%. 8% of preferential capital, that is 40 lakhs. Okay, so less the preference dividend 8% of 40 lakhs, 3,20,000. Then equity dividend is going to the end as also 8%, but that capital is 80 lakhs. So equity dividend 8% of 80 lakhs, that will come to 6,40,000. From this 15,80,800 minus those two figures, 3,20,000 and 6,40,000, you'll get retained earnings, which is nothing but your undistributed profits of 6,20,800. 6,20,800. So if they ask me 5% of undistributed profit, this is undistributed profit. Distributed profit to equity shareholders. Distributed profit, equity shareholders. Okay, I may require this because I will require to calculate now 50% of distributed profits and 5% of undistributed profits. Something like that is given. So I'll have to calculate that. Now, after doing this, next step will be to calculate the interest and dividend coverage ratio and capital gearing ratio. So calculation of interest and fixed dividend coverage ratio. Formula. Bapre. No, formula is not known. Coverage ratio. Interest coverage. Dividend coverage. What is the profit that covers dividend? NPAT. What is the profit that covers interest? Profit before interest. So NPAT before interest, that will be NPAT plus interest, numerator. What we have to cover? Debenture interest and preference dividend. So formula is NPAT plus interest upon interest plus preference dividend. This interest is nothing but debenture interest. NPAT plus debenture interest upon debenture interest plus preference dividend. Now what some intelligent students are going to do? Sir, debenture interest cancel. Array, we are not supposed to cancel. There is a plus sign here. Did you follow? Don't cancel interest and interest because it is a plus sign in between. Multiplication sign, if it is there, you can cancel. Numerator and denominator, you are having multiplication sign, you can cancel. Plus sign, you can't cancel. What is NPAT? Go to your statement that you have prepared of NPAT. 15,80,800. Debenture interest 7,68,000. Divided by 7,68,000 plus preference dividend 3,20,000. That comes to 23,48,800 divided by 10,88,000 divided by 10,88,000. So that comes to 2.16. Now, capital gearing ratio. Next one is capital gearing ratio. Actual formula is capital bearing fixed rate of interest or dividend upon capital not bearing fixed rate of interest or dividend. Now, it's such a big formula you have to learn. We'll simplify this now. Capital bearing fixed rate of interest or dividend. Capital bearing fixed rate of interest, debentures. Capital bearing fixed rate of dividend, preference share capital. So debentures plus preference share capital numerator. What will come in denominator? Not bearing fixed rate of interest or dividend. Equity capital does not carry fixed rate of interest or dividend. Reserves and surplus does not carry interest or dividend. Okay. So I will write it as preference share capital plus debentures upon equity share capital plus reserves and surplus. RS. RS means what? Short form for reserves and surplus. Okay. Substitute 40 lakhs plus 64 lakhs divided by 80 lakhs plus 32 lakhs. Preference share capital is 40 lakhs, debentures are 64 lakhs. Total amount of equity share capital is 80 lakhs, reserves and surplus 32 lakhs. You get 1 crore 4 lakhs divided by 1 crore 12 lakhs, that comes to 0.93. 0.93. Now to calculate yield on equity shares. How to calculate yield on equity shares? Yield, how to calculate? They have calculated as 50% of distributed profit and 5% of undistributed profit divided by equity capital. Okay? And if you want, you can multiply by 100 for a percentage. So calculation of yield on equity shares. 50% of 6,40,000, 5% of 6,20,800 divided by equity capital. 80 lakhs is what? 80 lakhs is equity capital. So that comes to 3,20,000 plus 31,040 divided by 80 lakhs. Percentage form, it will come to 4.39%. You can calculate this, multiply by 100. Multiply by 100. So you get 4.39%. Now we compare this with the industry average that we are given. The industry average is given to us. What is the industry average given to us? Profit after tax covering the interest and dividend is 3 times. Do we have dividend coverage ratio more than 3 or less than 3? Check what you have calculated. How much you have got? More than 3 or less than 3? You have got the amount as 2.16, but industry average is 3. So capital gearing ratio, how much we have got? 0.93. Should have been less. Industry is 0.75. So if I take into consideration these two factors, what do I find? I find that the dividend and interest coverage ratio of the industry is better, is higher. They are having more profits. Capital gearing ratio of the industry is comparatively lower. Our company is highly geared company. High gearing is high risk. Therefore, we have to understand that our company is much more riskier than the other companies in the same line of business. Our company is much more riskier than other companies in the same line of business because we are having less of profit and high gearing, more of borrowed capital, which means that our shareholders are going to ask for a higher rate of return. Industry, they are getting 9.6%, but our shareholders will ask higher rate of premium, higher rate of dividend. So the risk premium will increase for our company. So let us write down. What do we write down? If we compare the company results with the industry average, then we find that A, dividend and interest coverage ratio of the industry is better than us, is higher than us, 3 times. We are having less than 3. Okay, so industry profit is more, our profit is less. Capital gearing ratio of the industry is lower, that means less risk, less of borrowed funds, less of risk. We are having more of borrowed funds, more of risk. So our company is much more riskier. Thus, it is necessary to understand that company under consideration is riskier. So equity shareholders will demand a higher risk premium. So this is the consequence of that. This is the consequence of that. Whenever the risk is more, equity shareholders will ask for a higher dividend. So higher dividend means more risk premium is demanded by them. More risk premium is demanded by them. Now, from here, problem takes a turn. It takes a twist. Now, how much premium that they are going to ask, we do not know. They may ask for a 1% premium more. They may ask for a 2% premium more. They may ask for a 5% premium more. We don't know. Do we know? We don't know. So that means that it will be difficult for us to work out if I don't make any assumptions. So what is required now is assumption. What will I assume? I will assume that for the difference in coverage ratio, dividend coverage ratio, they will ask 1% more premium, 1% extra premium. And for every 1 unit of difference in CGR, CGR means capital gearing ratio, they will ask 2% premium. Okay, since our company is more riskier, the risk premium is going to be higher. The demand made by the equity shareholders of dividend will be higher. They will not accept 9.6%. They will accept something more because of the higher risk. So 1% more for every difference in the dividend coverage, every unit of difference in the dividend coverage ratio, and 2% more for every difference in the CGR. So I write like this. Hereby assume, this is my assumption. You can assume anything. You can assume 5% and 10%. You can assume 4% and 8%. You can assume anything. But I have, for simplicity purpose, taken simple figures, base figures, 1% and 2%. 1% for every unit of difference in coverage ratio and 2% for difference in CGR. Okay. So how it will be calculated? For difference in coverage ratio, 3 times, no? So 3 minus our figure, 2.16 into 1%. Okay. So that will give me 0.84 into 1%, that is 0.84. Second, for difference in CGR, 0.75 minus 0.93. Industry average was 0.75. Our average is 0.93. Difference in the two into 2. We are not concerned with the plus minus figures here. We are only concerned with the premium. When you multiply this by 2, you will get 0.36. So this much more they are going to ask. This much more they are going to ask. So what will be the expected yield then? 9.6 plus 0.84 plus 0.36. Expected yield is 9.6 plus 0.84 plus 0.36. That is 10.8%. And now, value of equity share will be given by the formula actual yield upon expected yield divided by into paid up value per share. Actual yield is 4.39%. Expected yield is 10.8 that we have got here. This is expected yield. Okay. Into paid up value per share. If nothing is given, I will take it as 100 rupees per share. So 4.39 divided by 10.80 into 100. 40.65. Write properly so that you write your statements properly. And if you are not able to, adjust the speed here, you can pause the video, write down, and then continue. I suppose you are now having full details and you are having more knowledge than me here as to how to operate a lecture on YouTube. You are having smartphones, you are having technology in your hands. So you have got more knowledge than me as far as running a video lecture is concerned, isn't it? Strategic financial management, I have got more knowledge than you. But technology, use of technology, or rather misuse and use of technology, both you are experts. Correct now. Here I have to learn something from you. Done. Any questions? Any difficulty? Shall we proceed? Yes. Now turn to page number 71. Page number 71. Concept of bond. You're having there concept of bond. Okay. Let us come to that. Now this part is going to be very important for us because we are going to have problems based on valuation of bonds, and the valuation of bonds is an important part of your calculations. So first of all, what is a bond? A bond is nothing but a long-term debt instrument. So when we are talking about bonds, it is nothing but a long-term debt instrument that we are having, where a long-term loan is taken in the form of a bond. So it is a security. Bond is a security with a borrowing arrangement. It obligates the issuer. Issuer is normally a company or a government to make specified payments to the bondholder. What are the payments? The interest on a regular basis, and after the maturity date, the principal. Okay. So a bond is nothing but a debt instrument. A debt instrument in the sense that it is like a loan taken for a long-term period of time. Now we can have bonds of different types. So what are the different types of bonds? First of all, we'll talk about government bonds. Government bonds. Government takes loan from public in the form of bonds, in the form of what we call as gilt-edged securities. Okay. So these gilt-edged securities are nothing but government-backed securities, which are long-term loans taken by the government through RBI. So they are issued by, these long-term bonds are issued by the Reserve Bank of India on behalf of India. And normally interest payment on these bank bonds are typically semi-annual. That means they pay half yearly interest. Semi-annual interest means half yearly interest. Then we have corporate bonds also. Now in India, the corporate bonds are normally referred to as debentures. But normally debenture is nothing but a bond. So debenture is nothing but a corporate bond, long-term loan taken by the company, which is normally secured. Okay. Then we have different types of bonds which are issued. The first one is straight bonds. Straight bonds, another term for that is plain vanilla bonds. So sometimes in your examination question, you may have something called as plain vanilla bonds. So plain vanilla bonds are nothing but straight bonds, where there is a fixed rate of interest that is payable, calculated on a half-yearly basis, semi-annual basis, and over a period of time. The time is fixed in advance, and on the maturity date, the principal amount is returned. Okay. Now, zero coupon bonds, ZCB. They are bonds which don't carry any rate of interest. They do not have any rate of interest, but they are normally issued at discount. It is always issued at discount and redeemed at face value. So the difference between the discounted value and the face value, that is the issue price and the redemption value, is normally the interest. You can call it as interest, you can call it as capital appreciation, whatever you want. But rate of interest is not there. Okay. Then we have something called as deep discount bonds. So it is nothing but another form of zero coupon bonds. When the discounts are huge, deep, that is why they are called deep discount bonds. They are sold at very large discounts, right? So like zero coupon bonds, they don't have any interest paid on a regular basis. What will happen is, since they are issued at a deep discount, that means let us say 1000 rupees bonds are issued at 750 rupees. The issue price will be 750 and the redemption value is 1000 rupees. So the difference of 2 rupees, 250 rupees per bond is your interest, or you can take it as the capital appreciation. But normally that amount is, the deep discount bonds are normally for a longer period of time. So they are normally for about 20 to 30 years. Okay. And there is a window open because sometimes investors don't like a long-term investment as long as 20 years or 25 years. So for such investors, there is a window open, an option open, say maybe at the end of 4 or 5 years, where they have the option of redeeming the bonds or selling off the bonds. Okay. So normally they have no payment of interest, no payment of interest. And it is usually for a period of 20 to 25 years. Then we have got what is floating rate bonds. Normally, the straight bonds which are there, they carry a fixed rate of interest. But floating rate bonds, they carry a variable rate of interest. Now, how that variable rate of interest is calculated? For example, in foreign countries, the variable rate of interest is calculated as LIBOR plus. They write something like this: LIBOR plus, LIBOR plus 2%. LIBOR is what? It is London Interbank Offer Rate. London Interbank Offer Rate. So whatever is a LIBOR plus 2%. Now LIBOR keeps on changing. So if the LIBOR is 6%, your rate of interest will be 6 plus 2, 8%. If the LIBOR is 2%, then your rate of interest will be 2 plus 2, 4%. So there is a benchmark. There is a particular benchmark to which your rate of interest is related to. Now in India, we have the treasury rate. That is the government rate of interest. Whatever is the treasury bill rate, that will be applicable. Or in India, we have something called as MIBOR, Mumbai Interbank Offer Rate. MIBOR is Mumbai Interbank Offer Rate. Okay. Then we have bonds embedded with options, convertible bonds. For example, convertible bonds are those bonds which are having the option of getting converted into equity shares at a later stage. Then we have something called as callable bonds. These are actually derivative bonds. Callable bonds has the option given to the issuer of the bond, whereby if the issuer of the bond, normally the company, is feeling that we are having enough cash, we can redeem the bonds, they can call back the bonds. That is why it is called callable bonds. They can call back the bonds before the due date, before the maturity date. But a notice has to be given. Normally, a 6 months notice is required to be given to the bondholder that we wish to redeem the bonds. So those are callable bonds, which has an option given to the issuer of the bond, that is normally the company. Then we have something called as puttable bonds. Puttable bonds are those bonds which are having the option but now given to the holder of the bonds. That is, the debenture holder or the bond holder is given the option that at any point of time he can sell back the bonds to the issuer before the due date, but by giving a due notice. Okay, so that is callable bond and puttable bonds. Then you have classification of bonds on other basis, like you have secured and unsecured bonds, where you are having bonds which are issued against the security of assets. These are secured bonds. Those bonds which do not have any secured assets, unsecured bonds. Then you have senior and subordinate bonds, registered and unregistered bonds, convertible and non-convertible bonds, and so on. Which means that there are different types of bonds. Basically, we can have different types of bonds. Normally, sometimes students have this, difficulty. Okay, sir, what is the meaning of senior and subordinate bonds? Sometimes a bond is secured against, let us say, plant and machinery. Value of the plant and machinery is 1 crore. Bond is of 40 lakhs. Okay, so a bond of 40 lakhs is issued against plant and machinery, against the security of plant and machinery of 1 crore. After some time, the company comes out with another bond issued against the same plant and machinery. Issued against the same plant and machinery. Now, and the second bond is of 20 lakhs. First bond was of 40 lakhs, second bond is of 20 lakhs. Both are having the security as the same plant and machinery of 1 crore. Now the problem comes that when the plant and machinery is sold, which bond will be paid first? So I say that whichever is a senior bond, whichever is a bond which is issued first, that will be paid first. So senior and subordinate bonds. Okay, like this we are having a lot of classifications which are possible. You can go through this, but now I want to come to an important part, that is concepts relating to bonds, bond related concepts. Okay, so we call them as bond terminology. Now, bond terminology, there are different terms that we are going to make use in the solving of problems. So we have to know the meaning of those terms and the application of those terms, where it is applied, how it is applied. So bond terminology, what are the terms that are used over here? First is face value. What is the meaning of face value? Face value is also called as a nominal value of the bond. It is the principal amount of the bond on which interest is always calculated. Interest is always calculated on the face value because that is a principal amount. So whatever may be the market value, you may have purchased a bond for 2000 rupees, but if the face value of the bond is 1000 rupees, interest will be calculated on the face value and not on the market value, not on the price on which you are calculating or on which you are purchasing. That is a market price. Then the second term that we use is coupon rate. What is actually the coupon rate? The coupon rate is nothing but the rate of interest that is calculated on the bond. Now this particular interest rate or the coupon rate that is there, as I told you, on government bonds, it is normally 99.99%. It is semi-annual payments. But in some cases where corporate bonds are issued, corporate bonds may be issued where interest is payable either annually or semi-annually or quarterly or any other basis. So the annual rate at which interest is paid, it is an interest rate, rate of interest. But we don't call it as rate of interest now. We are now professional people. We'll call it as coupon rate. Okay. Interest is usually paid semi-annually, but some companies may pay interest annually or monthly or on a quarterly basis. So that is what is coupon rate. The next most important thing is maturity date and maturity. If I say that a bond is issued for a period of 3 years and it is issued on 1st January 2001, okay, 1st January 2001 we have issued for 3 years, so 2001, 2002, 2003, 31st December 2003 is the maturity date of the bond. So what is the maturity date of the bond? It is the date on which the bond amount, the principal amount, has to be repaid and the bond will be standing as extinguished. That means the bond will come to an end. So the date on which the bond is to be repaid is called as a maturity date. Now, in some cases, what happens? The principal amount of the bond, in some cases, will be paid in installments. So let us say I'm having a bond of 1 crore, and I tell you that this bond of 1 crore will be paid every year. 1/10 of the amount is going to be paid. That means 10 lakhs will be paid every year for the next 10 years. So it is paid in installments. So for that, what is the maturity date? The date on which the last installment is paid. That is the maturity date. Okay. Now that is about maturity date. What is maturity? So I have told you what is maturity date. What is maturity? Maturity is the period from the date of issue of the bond till the date of maturity. From the date of issue till the maturity date of the bond. So first, what is maturity date? It is the date on which the bond is repaid and extinguished. Second, some bonds do not repay the principal amount in one installment, but spread it out over several years, so number of years. So the date of last installment is called as the maturity date. The time period till the maturity date is called as the maturity of the bond. Okay. Now sometimes what happens is bond is issued at 100 rupees, repaid at 103 rupees. Or a bond is having a face value and issued at 1000 rupees, but redeemable at 1200 rupees. So we are paying extra, that is called as redemption premium, where the repayment of the bonds takes place at a higher price than the face value. Then it is said to be repaid at a premium. For example, if a bond having a face value of 100 rupees is repaid at, that means on maturity we are paying 103, then 3 rupees is called as a redemption premium. Okay. Now, the next thing that we have learned, that we have got to learn, is something called as current yield. Current yield. Now, always remember, this particular concept of yield is going to be very important for us. Let us say, let us say that a company is having, he wants to issue 9% bonds. Company wants to issue 9% bonds. And the face value of the bond is, let us say, 1000 rupees. 1000 rupees face value. Now, the investor says that, oh, it's a 9% bond. We don't want. We want 10% interest. What do they say? We want 10% interest. Now, listen to the example carefully. Yeah? Company wants to issue 9% bonds having a face value of 1000 rupees. See, interest is always calculated on face value. So, face value is important. Investor says, if you are giving 9% interest, I am not interested in the bond. I will be interested in the bond only if I get 10% returns. He's now saying 10% interest. He's saying I want 10% returns. But if I'm not getting 10% returns, you are giving me 9% and you are issuing at 1000 rupees. I'm not interested in your bond. Now, how to change the mind of the company? Company is also very adamant. Company is also very strong. It says no, we are going to issue 9% bonds only. But if you issue 9% bonds, the investor is not going to buy. He will buy only if he is getting a return of 10%. So what do? You issue the bond. You issue the bond at 900 rupees. This is your issue price. So when you're issuing the bond at 900 rupees, this becomes, in other words, the market price at which the bond is sold. That means you are selling at a discount. You are selling at a discount of 100 rupees, 10% discount. So market price For the investor, when he is going to buy that one bond, he will pay how much? He will pay 900 rupees. He is going to pay 900 rupees. How much is his investment? His investment is 900 rupees. How much interest the company is going to pay? Company is going to pay 9% interest on 1000 rupees. So company is going to pay interest of 90 rupees. So investor has invested 900 rupees because he has purchased the bond at 900 rupees. Company is going to pay 9% interest only. That is 9% on 1000 rupees face value. So company is going to pay 90. Investor is going to get 90, but he is going to get 90 rupees for 900 rupees invested. So if you calculate rate of return for him, it is 10%. Rate of return for him, it is 10%. So company is also satisfied. Investor is also satisfied. Company is happy that it is paying only 9% rate of interest. Investor is happy because he has purchased the investment only for 900 rupees. So he is getting his returns for 10%. So what is current yield? When the rate of interest, what we are doing here, when the rate of interest, this is nothing but rate of interest. And this is what? Market price. When the rate of interest, you are calculating on the market price. Now rate of interest is called as what? Coupon rate or coupon interest. Then it is called as a current yield. So it is measured by comparing the interest earned on the bond with the current market price of the bond. And this is your formula. Now this I will multiply by 100 because I want it in percentage form. So have you understood? Achha, now why did I give you the figures? Pay attention now. Why did I give you the figures? I gave you the figures because there is a reason. And that reason is that I want you to understand one very, very important point. When expectation of the investor, that is the yield of the investor, I'm calling it as yield, because yield is what is the investor expecting. It is not the rate of interest. The rate of interest is 9%. What is the yield? This is the yield. Yield means what the investor is expecting. Investor is expecting 10%. Company is paying 9%. That means that if the investor is expecting a higher rate of return and you are giving a lower rate of interest, then the bonds should be selling at discount. So when the current yield is greater than the rate of interest, that is coupon rate, then the bonds are selling at discount. Have you followed? If the current yield is greater than the coupon rate, then the bonds must be sold at discount or issued at discount. Same way, I will not prove again, I will say same way, similarly, if the current yield is less than the rate of interest, suppose this was 8%, expected rate of return 8%, less than the coupon rate, then you can afford to sell the bonds at premium. If the current yield is less than the rate of interest, then you can afford to sell the bonds at a premium. What will happen? If the current yield is equal to the coupon rate? Then the selling price will be equal to the face value. That means the bonds will be issued at par. Have you followed? Now you can write down these points. First point, write down. It's not there in the book. I want you to write it down. If the bonds are selling at face value, then current yield is equal to coupon rate. If bonds are selling at face value, FV is face value, not future value, face value. If bonds are selling at face value, then the current yield is equal to coupon rate. Conversely, it is also true. Conversely, also you have to check if the coupon rate and the yield or the expected return of the investor is same, the yield is the same, then the issue price has to be the face value. Converse. Same way, if the bonds are selling at premium, then the current yield is less than the coupon rate. If bonds are selling at discount, then current yield is greater than coupon rate. If bonds are selling at discount, then current yield is greater than coupon rate. So all these points you have to write down. Please make a note of all these points, important points. First one, if bonds are selling at face value, then current yield is less equal to coupon rate. Second one, if bonds are selling at premium, then the current yield is less than coupon rate. Third one, if bonds are selling at discount, then current yield is greater than coupon rate. And fourth, the current yield takes into consideration only the interest. We are not taking into consideration capital appreciation, only the interest, and ignores the capital gains. Capital gains are not considered. Okay, is that clear? Is that clear? Okay. So as I said, if you think that the slides are moving a little bit fast, you can pause the video and then you can see, you can write down the points and then proceed. Now this current yield that is there, current yield is a common term. Current yield is a common term. In bond, we have got the concept of yield to maturity, YTM. Very, very important. This is very, very important. YTM. When a bond is bought, there is a cash outflow. That is what you are paying, the price that you are paying. As we said, that your company is issuing the bonds at a discount of 100 rupees. The market price, the price at which you are paying, 900 rupees. And then there is a series of cash inflows. These cash inflows are what? These cash inflows are nothing but the interest that you are getting, the periodic interest. Okay. The IRR of this stream of cash flows, internal rate of return, that means the rate at which you are earning these cash flows, gives the actual returns on the bond, which is the YTM. Now, important concept, IRR, internal rate of return. Now, again, this has been done in your inter-syllabus in the topic of investment analysis, or what we call as capital budgeting. Okay. Now, in this particular topic, IRR is not only the rate at which you are earning the cash flows, but IRR also includes the rate of reinvestment. See, first year you receive 100 rupees as interest. What you will do with that 100 rupees? You will reinvest and you will get some returns on that. So, returns on returns. What you will do with the returns on returns? You will again reinvest. So, this rate of reinvestment that you are getting on all the cash flows plus the original rate of return, together, when you take all the cash flows and you calculate the rate at which you have earned, then that is called as IRR, internal rate of return. That is called as internal rate of return. So, on the basis of that, we have got certain points that to be written, which we derive from the bond price theorem. Okay, so I want you to write down these points because these points are important for us. Give the heading bond price theorem. These are points which are similar to what you have written for current yield and relationship between current yield and your coupon rate. Instead of yield, current yield, I am using the term YTM. First point, market price of the bonds will be equal to face value of the bond. Market price of the bonds will be equal to face value of the bonds if YTM, yield to maturity, YTM, yield to maturity, is equal to coupon rate. Earlier we had said what current yield is equal to coupon rate. Now we are using the term yield to maturity, YTM. If YTM is greater than coupon rate, then market price is less than the face value. That means you are issuing at discount. You are issuing at discount. And third point, if YTM is less than coupon rate, then the market price is greater than the face value. That means you are issuing at premium. You have not copied. Okay. Three things. Market price of the bonds will be equal to the face value if YTM is equal to coupon rate. If YTM is greater than coupon rate, then market price is less than the face value. And if YTM is less than the coupon rate, then market price is greater than the face value. So, bond price theorem only we continue now. We'll write the conclusions. There are some very important conclusions that are going to come. Right now. Thus, we can conclude that. Thus, we can conclude that. The same thing. Bond price theorem only. What are the conclusions? Number one, a bond's price moves inversely proportion to its YTM. So as the YTM increases, the bond's price decreases. If the expectation or the yield of the customer increases, you have to issue at discount. So the price moves inversely with the YTM. Bond's price moves inversely with the YTM. Second, for a given difference between YTM and coupon rate of the bonds, longer the term to maturity, greater will be the change in price with change in YTM. Longer the term to maturity. So if you have, let us say you have bond A with 7 years and bond B with 4 years. Two bonds are there. What is the meaning of this? Two bonds are there. Bond A with 7 years, bond B with 4 years. The remaining things are common. Rate of interest between the two bonds are the same. YTM is same. Everything is same. But bond A is for 7 years and bond B is for 4 years. What the point is saying is that if there is a change in the YTM, if there is a change in the YTM, that means if the YTM increases from say 8% to 9%, if the YTM increases from 8% to 9%, what will happen? YTM increases, price of the bond will decrease, but the change in price of the bond with longer term to maturity will be greater. That means the decrease in the price of the bond will be affecting bond A more than bond B. Why it is going to affect bond A more than bond B? Because bond A is for a longer period of time, 7 years. That is, bond B is only for 4 years. So the bond having the longer maturity, longer term to maturity, will be affected more by the change in YTM. Very interesting points. Now this point you will have to observe when you are solving the problem, because they ask you to comment on the change in the price of bond A and bond B. So what comment you will write? You will write this comment only. This is a conclusion. This is the point that you would write, isn't it? Third point. Given the maturity, the change in bond price will be greater with a decrease in the bond's YTM than the change in the bond price with an equal increase in the bond's YTM. Will be greater with a decrease. That means if the YTM decreases, then bond price, let us say YTM decreases by 1%, the bond price increases by 5%. And the bond price increases, the bond YTM increases by 1%, the bond price will decrease only by 3%. So change in the bond price will be greater with a decrease in the YTM than with an equal increase. That means 1% decrease is going to bring about more change in the price of the bond than 1% increase. Okay, if with 1% increase, 1% decrease in YTM brings about change in price by say 5%, okay, then same 1% increase in the bond, in the YTM of the bond, will result in change in price, but it will be maybe only by 3% or 4%, but not 5%, it will be less. Change in bond price will be greater. Change in bond price is greater with a decrease in the bonds YTM. 1% decrease results in 5% change. Here, 1% increase results only in 3% change. This is very important. When you're learning the conclusions, you don't have to learn these conclusions as such because they are not going to ask you this. But when you solve the problem, they will say, comment upon or what do you observe in the change in the price. So when they ask you what do you observe in the change in the price, you have to say that, sir, we observe that when there is a decrease by 1%, then there is more change in the price as compared to a similar equal increase. They have said equal increase. I'm not increasing this by 5%, I'm increasing this by 1% only. Do you follow? So this has to be employed when you are solving the problems. You have to remember these points. You are not supposed to by heart these points. No, 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 no. You are supposed to remember these points. Remember these points. Okay. So now we will take up some problems, some questions on bond price theorem. Bonds. James Bond. Let us come to question number 7. Question number 7. Go to your book. Page number 81. Question number 7. Page number 81. Question number 7. Got it? Okay. Let us see what is the question. S Limited has issued convertible debentures with coupon rate of 12%. Always underline when you're going through the question. Coupon rate of 12%. Rate of interest 12%. Each debenture has an option to convert into 20 equity shares at any point of time till the maturity date. Debentures will be redeemed at 100 rupees on maturity of 5 years. Investor requires a rate of return of 8% per annum on a 5-year security. As an investor, when will you exercise the conversion for given market prices of the equity share of 4 rupees, 5 rupees and 6 rupees? Cumulative PV factor is given to you. Present value factor for 8% is given to you as 3.993. This is the annuity factor. Annuity factor. Okay, this is the annuity. If you're doing annuity calculation, you'll require this. And present value factor for 8% for 5th year. This is your single cash flow. If you're doing single cash flow. Okay, now the first thing is, what is 8%? What is this 8%? This 8% is your YTM. Okay, coupon rate of interest is how much? Coupon rate of interest is 12%. And yield is how much? 8%. YTM is 8%, less than coupon rate of interest. That means the intrinsic value of the debenture, or market value of the debenture is higher than the face value. Value of the debenture is higher than the face value. Okay, so let us see how to solve this now. Now one debenture is of 100 rupees. If I am going to convert this into equity shares, how many equity shares? 20 equity shares. So 100 divided by 20, I will be having value of each equity share as 5 rupees. I will be having value of each equity share as 5 rupees. So 5 rupees if I sell, market price is also 5 rupees. 20 debentures, sorry, 5 equity shares if I'm going to sell, 20 equity shares if I'm going to sell, and if the market price is 4 rupees, I will get 80 rupees. So for a 100 rupees debenture, I'll sell and get 80 rupees. 20 shares, if I sell at 5 rupees, 20 into 5, I'll get 100. So that means I will be selling only when it is more than 5. If it is 5 or less, I will not sell. I will not convert because the purpose of conversion is to sell in the market. Okay. So if 100 rupee debenture is going to be converted into 20 equity shares, that means the value of each share will be 5 rupees. Now, if these 20 shares are sold when the market price is 4 rupees, then I will get back only 80 rupees. If these 20 shares are sold when the market price is 5 rupees, then I will get back exactly 100 rupees, 20 into 5. But therefore, there is no point in converting those debentures into equity shares. I will convert into equity shares only when I sell those equity shares, those 20 equity shares, if I sell, if I'm getting a higher value. And that will be when I get 6 rupees per share. So now all these things I have to put it down. I have to show it in the form of working. So let us see. First I'll write coupon rate of interest is 12%. Given YTM is 8%. This is given to me now. Rate of interest is given. YTM is given. Next thing what I will write, I will say since YTM is less than coupon rate of interest, the intrinsic value, or you can say the market value instead of intrinsic value. If you are getting confused, you can write market value. Market value of the debenture is higher than the face value, or the intrinsic value of the debenture is higher than the face value. What is the face value? Face value of the debenture is 100 rupees. If this is going to be converted into equity shares, how many equity shares? 20 equity shares. Then I will be giving my debenture holders 20 equity shares. So value of each equity share will be 100 divided by 20. That is 5 rupees. So I conclude that if market value of equity shares is 5 rupees or less, it is not advisable to convert into equity shares. Because 20 equity shares I sell at 5 rupees, I get back 100 rupees. What is the point in conversion? I'll let it remain as a debenture only. At least I will get the fixed rate of interest. Correct now? So coupon rate of interest 12%. YTM is given to me as 8%. YTM is less than coupon rate, so intrinsic value is higher than face value. Face value of a debenture is 100 rupees. If it can be converted into equity shares, 20 equity shares will be given. Value of each equity share is 5 rupees. Okay? Right? Now, let us see the next step. That means if it is 5 or less than 5, I am not going to convert into equity shares. No point. What will happen if I convert into equity shares? When the market price is 6 rupees. Then I get the benefit. Let us see. If market price of an equity share is 6 rupees, how many equity shares am I getting? 20 equity shares. So market value of 20 equity shares, 20 into 6 rupees per share. That is 120 rupees. 120 rupees. Intrinsic value of debenture at 8%. How to calculate? Rate of interest into annuity factor. That is the amount of interest into annuity factor. Because the amount of interest is going to be earned every year and the amount is going to remain same. So every year if I'm receiving same amount, it is a case of annuity. Plus at the time of redemption, I'm getting the redemption value. What is the redemption value? Redemption value is the face value. What is the face value? 100 rupees. Okay. So 12 into 12 is this is my interest. Interest. Am I calculating interest on the face value of the debentures? 12% was the rate of interest, coupon rate on 100 rupees is 12 rupees. Annuity factor at 8% for 5 years plus 100 rupees redemption value into PVIF at 8% for 5th year. Now, how to calculate 3.9927? How to calculate? How to calculate this figure? 1 divided by 1 plus k, that is 1.08, equal to function 5 times. Equal to function 5 times, and then there is a GT function on your calculator. There is a GT function on the calculator. GT function on the calculator. GT function. You can see? Okay. So press the GT function. 1 divided by 1.08 equal to function 5 times. Press the GT function, you will get 3.9927. Alternatively, what you can do? Alternatively, you can take the values that they have given. If they have not given, I'm telling you how to calculate. They have given 3.993 and they have given 0.681. So you can take those figures also, no problem. So in case the values are not given, assuming that values are not given, you can calculate and arrive at these figures. Okay, then 47.91 plus 68.06. So total value is 115.97. That means intrinsic value of the debenture, the actual value of the debenture at that point of time, what will be the market value of the debenture? The market value of the debenture, if you sell, it will be 115.27. Face value is 100. Face value is 100. If you sell the debenture when the market price of equity share is 6 rupees, when you sell the debenture, you will get 115.97. But now, since you are going to convert into equity shares and the equity shares you are getting 120, which is higher, selling a debenture is higher or better, or selling equity shares is better? Selling equity shares. So I will sell the equity shares and get 120 rupees. So since market value of 20 equity shares is higher than the intrinsic value of the debenture, it is better to convert the debentures into equity shares. It is better to convert the debentures into equity shares. See that you are writing properly. Even if you take the figures given by them, let us see what we get by taking the figures given by them. 3.993. So 12 into 3.993 is equal to 40.916. And 100 into 0.681 now. So that also you get 68.1. More or less same you get. 47.91. Around 116 you get. Not an issue. Okay. Point is clear. Point is clear. Okay. Now let us go to question number 8. Very simple question. ICICI Limited has a 14% bond outstanding that matures in 10 years. The bond has a face value of rupees 1140. It currently sells for rupees 1050. Face value, very important, face value. Always underline the face value when you come across the face value. Currently sells for 1050, intrinsic value, 1050, value of the bond. Calculate the YTM of the bond. YTM is not given. Assume that interest rate payments are made semi-annually. Another calculation here, semi-annual. Interest rates are semi-annual. So 14% bond means half yearly we are paying 7%. 14% annually. So half yearly we are paying 7%. So coupon rate is 7% for 6 months semi-annually. Calculated on face value. What is the face value? 1140 is the face value. Okay. Have you understood? Chalo, let us find out how to solve. Question 8. Coupon interest is given 7%, 14% annually, 7% for 6 months. Always to be calculated on face value. So we get 79.80 semi-annual. How to calculate value of the bond? Interest into annuity factor plus face value into PVIF. What is the value of the bond given to me? 1050. Interest is 79.80. I've just calculated. Into annuity factor at K rate of interest. K is your YTM for 20 installments. 20 installments. Actually, it is 10 years. Maturity is 10 years. But how many half years are there? There are 20 half years. In 1 year, there are 2 half years. In 1 year, there are 2 half years. So in 10 years, there will be 20 half years. So 20 periods are there. Plus 1140 face value into PVIF, single cash flow, at K rate of interest. That is your YTM for 20 installments, 20 half years. Is that clear? Now, next thing that I'm going to do, always, I will say that for calculation of YTM, YTM is what? YTM is IRR, sir. Did you have formula for calculating IRR? No, sir. It was trial and error. And then we did interpolation, sir. So IRR, this is also IRR only. I told you YTM is nothing but IRR. So we have to do trial and error. So let us do trial and error. If K is equal to 7%, if K is equal to coupon rate, if K is equal to coupon rate, then what it means? YTM is equal to coupon rate. If YTM is equal to coupon rate, intrinsic value is equal to face value. By bond theorem. By bond theorem. Once again, I am repeating. I say let K is equal to 7%. I am trying to find out K, na, trial and error. Let K equal to 7%. But what is 7%? 7% is coupon rate. That means I am saying let YTM equal to coupon rate. If YTM is equal to coupon rate, then value of the bond is face value. Alright, did you understand? At K is equal to 7%. This is by bond theorem. That is why I did all those points of bond theorem. I told you write down these points. So at K is equal to 7%, YTM is equal to coupon rate. Value of the bond is equal to face value. Now I require 1050. What is the required value? 1050, which is less than 1040. I want a lower value, so I will increase the discounting rate. I will take a higher discounting rate. I want 1050. I want this figure. But I'm having 1140. So I want to reduce this 1140. How to reduce? By taking a higher discounting rate. So I say, since required value is less than 1140, we take a higher rate of discount. We take a higher rate of discount. So higher rate means what? I will take 8%. 8% semi-annual. That means annual 16%. So I say, consider K is equal to 8%, 16% per annum. So I say P0 is therefore equal to interest amount. This we have already calculated. Interest amount does not change. Interest rate does not change. What changes? YTM changes. So annuity of 8% for 20 periods. Annuity of 8% for 20 periods. Let us do it. All of you are sitting with calculators. I am also sitting with calculator. 1 divided by 1.08 equal to function 20 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. And then GT function. and then GT function. I'm getting exactly 9.8181, 4 digits rounded up. 9.8181, 4 digits rounded up. Clear? So what did I do? How did I calculate this? It is 1 divided by 1.08 equal to function 20 times. Okay, I'm teaching you KG class stuff now. First standard. Primary KG, lower KG, upper KG. Okay, 20 times you have to press. Then you press the GT function. This is to be taught in Inter CMA. You have to make use of your calculator. You may have a better method of doing it. So please do it. How did I get this? This single cash flow. So 1 divided by 1.08, 1 divided by 1.08 equal to function 20 times. 2145. Multiply, you will get this answer. Add, you will get this answer. Now, this is also not the figure that I require here. So, what I will do interpolation. So, I say by interpolation. Now, how to do interpolation? Sir, how to do interpolation? What I will do is, I will write the figures, whatever figures I've got. How? I don't want formula. I will write the figures. How to write the figures? Two figures I have got. One is 7% wala, one is 8% wala. 7% wala figure is 1140. 1140. 8% wala figure 1028. And in the center, I write required value. Required value is 1050. Correct? Well, the required value is 1050. Now I take difference between first and second and difference between first and third. Difference between first and second is 90. Difference between first and third is 100 and how much? This is 1028. 112. Correct now? Difference between first and second, difference between first and third. Now I put it in the formula. Y is equal to 7 plus. 7 plus in the numerator I will be having difference between first and second. Denominator I am having difference between first and third. So the value is 7 plus 90 upon 112. Interpolation. Lower limit, upper limit. Lower limit comes here plus fraction. This fraction 90 by 112. Don't study formula. Formula studying is of no use. Understand it this way. I hope you have understood. So YTM is equal to 7.8%. But this YTM is equal to 7.8%. This is semi-annual. This is semi-annual. I want annual figure. How to calculate annual figure? Don't multiply by 2. Wrong. If you multiply by 2, it is wrong. What you have to do? Annual YTM formula is there. 1 plus k the whole raised to 2. Why? Because it is semi-annual. Since it is semi-annual, it is compounded twice. So it is raised to 2. If it is quarterly, it will be raised to 4. Okay, minus 1. K is what? 0.0780. Solve this. You get 1.1621 minus 1. That is 16.21%. 16.21% per annum. Formula is important. Calculation of annual YTM formula. Semi-annual to annual. Done. As I said once again, don't panic if you're not able to write. You can pause the video, write, and then move ahead. Are you tired? I don't think you are tired because you only asked. The students have asked me, many students have asked me to increase the length of the lecture, sir. 1 hour is not sufficient. We require minimum 2 hours. We are willing to sit for 3 hours. You are willing to sit, Baba, but I am not willing to sit. Now I have to sit continuously for 3 hours. If it was standing, it was a different issue. I can't sit for 3 hours continuously. I can stand for 3 hours. So standing, I can move around. Sitting, I can't move around. Then you wish now that there were face-to-face lectures. The face-to-face lectures would be more interesting. But because of this lockdown, everything has gone for a toss. But your studies will not go for a toss. As long as I am there for the subjects, whichever I am teaching, I will ensure that you are learning on a day-to-day basis. Lockdown will be converted into productivity, strategic, cost management, strategic, financial management. So since I'm faculty of two strategizing papers, I've strategized that we'll use the lockdown period for productivity, increasing our knowledge, enjoying sitting at home, getting the benefit of lecture in the house vicinity. So you can have your, whatever chips or whatever is there, you can have that side by side as you are writing the solutions, as you are watching the video. It's like a movie that is going on, isn't it? Enjoy. Okay. Chalo. Let us come to question number nine. Ninth question. Market is important. Important question. Important question. Consider two bonds A and B. Face value 100 rupees, coupon rate 14%, market price 100, term to maturity 4 years, 7 years. All things same, only what is different? This is different. Compute the YTM of bonds A and B. What a big question here. Compute the YTM of bonds A and B. Array, there is nothing to compute the YTM as such. Why? Because market price and face value are same. So market price, if it is equal to face value, then what does the bond theorem say? That coupon rate is equal to YTM, or YTM is equal to coupon rate. Yes or no? If the market price and face value are one and the same, then the YTM and coupon rate also will be one and the same. So they are asking compute YTM of the bond. Tell them, Arey sir, why you are asking this question? Stupid question. YTM is same as coupon rate, and that is 14%. Correct na? So that is the first answer. Second, if the interest rates fall by 1%, now they give you as interest rates fall, but interest rates don't fall. Interest rate, which interest rate they are talking? The YTM is falling. YTM is falling. Whenever they say interest rate, don't be carried away by the term interest rate and say that, sir, interest rate is falling. No, YTM is falling. Interest rate does not change. And interest rate will always be calculated on the face value. So interest will always remain 14% of 100 rupees. 14% of 100 rupees. It will remain always 14 rupees. Always 14 rupees. It is not going to change. Interest is not going to change. YTM changes, let it change. What we have got to do, isn't it? Interest rates fall by 1%. So YTM from 14% will come down to 13%. What is the new price of the bond? So value of the bond has to be calculated. What is the percentage change in the price of the bond? If the interest rates increase by 1%, then what will be the new price of the bonds? What is your observation? What you have to write here? 1% increase, 1% decrease. The change in the value of the bond on account of decrease should be more than the change in the value of the bond on account of increase. Let us see if this comes or not. If it comes, then I am correct. If it does not come, then you are wrong. Question 9. So first what do I write? I say since the market price of both the bonds are the same as the face value, the YTM will be the same as the coupon rate, that is 14%. Write down. Don't look at the screen. Write down. Since the market price of both the bonds is the same as the face value of the bonds, the YTM will be the same as the coupon rate, that is 14%. Then, if YTM reduces by 1%, then YTM becomes 13%. Coupon rate, it will remain 14% only. Interest will be 14% only. Value of the interest will not change. So let us see what is going to be the value of the bond. Value of the bond A will be 14 rupees interest plus into annuity factor at 13% for 4 years. Okay. And 100 into PVAF at 13% for 4 years. So in same way I do 1 divided by 1.13 equal to function 4 times and then GT function for annuity factor. So that comes to 14 into 2.9745. This is 1 divided by 13 equal to function 4 times the last figure is 0.6133. Multiply. 41.64 plus 61.33. Rounded up to 2 decimals. Round up to 2 decimals. So total comes to 102.97. 102.97. Value of bond B, 14 rupees. Interest rate does not change. 14 rupees into annuity factor at 13% YTM for 7 years. And second one, redemption value 100 rupees face value into PVF at 13% for 7 years. Now you calculate without me showing you. 1 divided by 1.13. 1 divided by 1.13 equal to function 7 times GT function. 1 divided by 1.13 equal to function 7 times and then press the GT function on the calculator. So there you will get 4.4226 and the last one 0.4251 multiply add. Finished? Third part. Let us see the difference now. Percentage change in value of bond A. First it was 100 rupees. Now it is 102.97. So the percentage change is 2.97. Percentage change in value of bond B. 104.43 minus 100 upon 100. So 4.43. What you observe over here is that the bond B is having 7 years now. Bond B is having 7 years and bond A is having 4 years. So the bond having longer maturity is having more effect. It's having more effect, more change. Now if the YTM increases by 1%, same way you have to do. YTM increases by 1%. So YTM will become 15%. Value of bond is 14 into annuity factor at 15% for 4 years plus 100 into PVIF at 15% for 4 years, 4th year. Calculate the annuity factors. You get 2.8550, 0.5718, 39.97, 57.18, 97.15. Same way you do for bond B also. Use your calculators. Check the figures. Factor values to be rounded up to 4 decimals. Amount to be rounded up to 2 decimals. Now calculate the percentage change. Originally it was 100, now it is 97.15. So decrease by 2.85%. Originally it was 100, now it is 95.84. So decrease by 4.16. Percentage change in value of bond A. 97.15 minus 100 upon 100 minus 2.85%. 95.84 in minus 100 upon 100 into 100 for percentage minus 4.16%. So the bond having greater maturity value from the bond theorem, bond having greater maturity value, longer term to maturity, has a higher price change as compared to bond having a short term maturity, 4 years. Bond B is having 7 years, bond A is having 4 years. So the percentage change in bond B is more than in bond A. Percentage change in bond B having 7 years to maturity is more than percentage change in bond A having only 4 years to maturity. So from C and D we can observe that as YTM changes by 1%, the bond having a longer term to maturity experiences a price change higher than a bond which has a shorter term to maturity. Bond price theorem. So today we have covered a lot of questions. We have covered about 9 questions or so. In the next lecture, again we are going to have bond valuation continued, security valuation continued. Some more important questions are there, which we will be doing. And then we move on to portfolio management, security analysis after we complete in the next lecture, possibly, hopefully, then we'll start with portfolio management. But start revising all your formulas of cost of capital ratios, etc. If you want to do your finals thoroughly, properly, it is an advice depending on whether you want to pass your finals in first attempt or you have a long-term planning for that first attempt. Okay, so till the next lecture, ensure that you are staying at home, stay at home, stay safe. God bless you.